Our trade on United Airlines has now made more than 900% profit. And on the last trading day, when the stock hit a new high, we detected new data of unusual option activity. And so in this video, not only will we show our new strategy, but we will analyze this data of how wealthy investors are now trading United Airlines. Are they still bullish and buying, or are they now bearish and selling? So that we can also make the same financial decisions to make money while the rich are getting richer on Wall Street. Because as we all know, the rich have more access to information, including leaked insider information, to make better financial decisions. No wonder the rich get richer. And so without further ado, let's dive into our trade. Now, if you've been following our channel, you know that back on September 13, when we entered our trade, we shared this video because we detected these unusual options. And so if you missed out on this video, you can search for the title on our channel here. We will also put a link at the top here in case you missed it. Make sure to watch it and subscribe and hit the bell icon so you don't miss out on these very profitable opportunities. Because you can see that ever since we entered our trade, when these unusual options were analyzed, it has gone up 62%. And we had detected another data set of unusual options and locked in some of our profits on September 27 on this day when there was a pullback here as well. And so ever since then, it still continued to go up higher, another 35% to new highs. And so this goes to show that our analysis of these unusual options are consistently helping us make better financial decisions. And you can see how much profit we were able to make using options instead of stocks on this profit loss graph, analyzing options. These 52.5 strike calls that we originally analyzed to get into this trade, expiring November 15, they had only cost $280 each when we initially got in. And you can see that because United Airlines is now trading at $80 a share, very deep in the money, these call options, $2,534 of profit per call option. And since this graph already takes into account the cost of the call options of $280 per trade, in order to calculate the profit percentage, we simply need to divide the $2,534 of profit by the $280 cost, multiply by 100 for a percentage, and you can see that we've made a total of 905% profit on this trade so far. So very profitable, which means that by having this one trade, we can actually lose the next 9 trades and still be net profitable. So this goes to show why diversifying your portfolio with trades of unusual options activity can consistently beat the market, because just one of these winning trades can gain so much more than what you could lose using options. And so if you want more of these trade ideas that the wealthy investors are in, then make sure to go to our website. Diversification is very important because not all of these trades will be winners. There will be losers in which you could lose 100% per option trade. But as we've shown here, you could also gain 905% profit on one trade to overcome all of your losing trades. So keep that in mind if you are trading unusual options, that you have to diversify, because some of these trades will be very, very profitable and will push you well above being net profitable in the long run. Now remember, we also had updated and locked in profits when we detected these March 21st 70 strike calls, and these are also profitable. Now, how do we know that these options were being traded? Well, when we take a look at the historical data back in mid-September, when the stock was trading at just $50 a share, those November 15 options at the 52.5 strike calls were going for the $280 per call option. and there were 10,000 of those contracts that were being traded at the volume that we had detected and analyzed and showed in our video over here. So again, make sure to watch this video if you missed it, because you can learn a lot on how we were able to find this trade to make this 905% profit. Now we started to update and lock in some of our profits, because about 2 weeks later, you can see on September 30th here, we have these March 21st options at the 70 strike calls over here, 4,000 contracts that were being traded, and they were paying about $270 for each of these options. And we had found that they were still going bullish long, so we kept staying in the trade by analyzing those March 21st options here at the 70 strike. So these also kept on gaining in profits, where we've locked in the profits. They were a no loss trade by then, because the cost of this trade was much less than the profits that we had already rolled from the November 15 options. So we continued to gain in profits. And so what we've done now is closed out of all of our call options for both of these and rolled to a new strategy because of the new data. Now you can see here the new data on the option time and sales tape. On November 1st at 11:56, we have these options being traded, the January 17 options at the 85 strike calls and the December 20 options at the 75 strike calls. We can see here the number of contracts being traded, 6,200 for the 85 strike calls, and we have 3,400 and 2,650 for the 75 strike calls expiring December 20. Now, what are they doing over here? So let's take a deeper look at the option chain for these December 20 options. We can see here that these 75 strike calls have an open interest of 21,000. And based on our analysis, they were closing out of these trades to take profits. You can see the volume of 6,000 closing out, and they were rolling to a new strike price for these January 17 options. And we know these are opening trades because at the 85 strike calls, we have the 6,000 volume greater than the open interest of 3,528. And so we can calculate the total trade cost now that we know that these December 20s are the closing trades and these January 17 options at the 85 strike calls are the opening trades, 6,200 contracts. And so we multiply by the price that they paid, $526. We have to multiply by 100 to get options pricing because each option represents 100 shares of stock. So we multiply by 526, and so this trade was $3.2 million. And so when we analyze these call options at the 85 strike calls, where they were paying $526 for each of these call options, you can see that this is also still going bullish. As the share price goes up, these options gain positive profits. If it goes down, it becomes more negative loss. And so this wealthy investor is going long bullish. And we can confirm it on the Greeks here. We have a positive delta. If it was a bearish short trade, it would be a negative delta. Now notice that the risk on this trade here with a -4 theta per option. So that is a higher risk trade, especially when the stock is also very overbought at new highs on a lot of the technical indicators, such as the RSI. Now, the way we traded this, because it is higher risk, we wanted to roll into a newer strategy. And you can see that we are in this position here at the same 85 strike calls. POS stands for position. Green means buy. But because we wanted to reduce our risk on theta or time decay and lower the cost of our trade, what we did was we went to the December 20s and we sold the 95 strike calls. You can see our position here, but it is red, which means sells. So we sold these call options. And so when we analyze our trade, you can see that this is our strategy. It is a diagonal strategy. It costs $386 per trade, so less than the unusual options at 526. And the reason why we wanted to get into this trade is to lower the risk, because you can see for our Greeks, we have a -1 theta, so not as negative than the unusual options. We are still going bullish long with a positive delta trade. And also keep in mind that since we rolled our options from a previous trade that had a profit of 2,534 that we originally calculated in the beginning of this video, and this new trade cost less 386 of debit, and so we subtract the 386 on this new strategy, and so we actually have a credit of $2,148 per trade, which means that we have a $2,148 credit trade. And so we've locked in profits so that if the stock goes down, there is no negative loss, even if the stock crashes. And if it goes up, we will be able to continue to make more profits. And so that is how we've managed our trade to reduce the risk, continuously rolling up our strikes like how the wealthy investors are doing as well. And so that is how we trade, by using option strategies to reduce our risk and also finding out which stocks the wealthy, rich investors are in so that we can make better stock picking decisions to diversify our portfolio to maximize profits. If you are interested in learning more and gaining access to our trades based on this type of data analysis, then make sure to go to our website. We'll put a link over here. Make sure to watch our initial United Airlines video over here where we analyze those options that have now made 905% profit. We'll put a link over here in the comments below. Let us know what you think about United Airlines stock. Do you think it will continue to rise and soar higher, or will it crash down? As usual, please smash the like button, subscribe if you haven't. Take care and have a wonderful weekend.